New NEMT operators like you walk into insurance quotes expecting $3,000 annual premiums, but you end up walking out with $12,000 bills and coverage that doesn't protect half of what you thought it did. Why? Because insurance companies aren't explaining what you're actually buying. Most NEMT startups spend $8,000 to $15,000 on insurance in year one and discover 6 months later that their policy has massive coverage gaps. Loading injuries? Not covered. Sexual abuse claims? Silent coverage that means nothing. Specialized equipment? Excluded unless you specifically ask for it. Welcome to NEMT, the place where NEMT entrepreneurs like you come to build empires. Today we're exposing the 15 secrets insurance companies won't tell NEMT startups, the gaps in coverage, the hidden costs, and the policy structures that leave you completely exposed when claims hit. Number 1, most policies don't cover loading and unloading. So here's the thing. Many NEMT claims happen during loading, unloading, or securement. Patient slips while boarding. Wheelchair tips during strapping. Door closes on someone's foot. Standard commercial auto policies, they cover accidents while the vehicle's moving. What happens in the parking lot, at the pickup location, or inside the vehicle while it's stationary? That's a coverage gap. Some policies throw these incidents under general liability instead of auto liability. Others need specific med pay or personal injury protection endorsements. A few exclude them entirely unless you add professional liability. The insurance company won't explain this during the sales call. They'll sell you the base policy and move on. 6 months later, when a claim gets denied, that's when you discover the gap. Number 2, silent SAM coverage is worthless. SAM is short for sexual abuse and molestation coverage, and it is required by more brokers and Medicaid programs now. Some general liability policies include silent SAM coverage, meaning the policy doesn't clearly exclude or include abuse and molestation claims, leaving coverage uncertain. Sounds like protection, right? It's not. Silent coverage leads to disputes with insurers when claims arise. The policy doesn't say no coverage, but it also doesn't say yes coverage. Real SAM coverage needs to be explicitly written into the policy, either as a standalone policy or as a clear endorsement to your general liability. Don't accept silent coverage. Number 3, your commercial auto policy doesn't cover specialized equipment. Wheelchair lifts, ramps, securement systems, stretcher equipment. These modifications make NEMT vehicles valuable. And yeah, standard commercial auto policies cover the vehicle, but wheelchair lifts and other specialized equipment might not be covered by a standard commercial auto liability policy. You need to add coverage as a rider. It's not even expensive, usually a few $100s annually. But insurers don't mention it exists because most operators don't ask. They'd rather issue the bare minimum policy and avoid the conversation entirely. Number 4, claims made versus occurrence. There are 2 types of policies, claims made and occurrence. And the difference can cost you $20,000 or more if you don't understand it. Occurrence coverage protects you for anything that happens while the policy's active, even if the claim comes years later. Claims made coverage, it only protects you while the policy's active. If you stop renewing and didn't buy tail coverage, you're no longer protected. Here's what that means. A patient files a claim in 2027 for something that happened in 2025. An occurrence policy from 2025 still covers you. A claims made policy doesn't, unless you kept it active or paid for tail coverage. And tail coverage isn't cheap. It usually costs 2 to 3 times your final year's premium. Claims made policies are cheaper upfront, which is why they're often sold. Occurrence policies cost more at the start, but there's no tail bill later. Which one costs more overall? It depends on how long you stay in business. A trade-off insurers rarely explain. Number 5, workers' comp classification traps. Most states require workers' comp for NEMT businesses with employees. That part's straightforward. What's not explained? What happens when you use independent contractors or let drivers use their own vehicles? In those cases, HNOA coverage is often required. And depending on how your contractors are set up, the state may treat them as employees anyway. That distinction matters because workers' comp premiums are based on payroll. If you classify someone as a 1099, but the state sees them as a W-2, you're effectively uninsured. When someone gets hurt, the state can come after you for back premiums, penalties, and fines, often tens of thousands of dollars. So here's what you need to do. Confirm with your agent how contractors are classified in your state, and make sure your workers' comp and HNOA policies reflect how your business actually operates. Number 6, vehicle age limits aren't disclosed. Many commercial auto insurers have vehicle age limits. Vans over 10 to 12 years old are often excluded or pushed into higher risk, higher premium policies. Here's the shady part. Insurers may still issue you a policy and collect premiums, then only raise the age issue after a claim, using fine print to reduce or deny the payout. They don't mention these limits during quoting because disqualifying your vehicle up front means losing the sale. So they sell the policy first and investigate later. So before you sign, get written confirmation that every vehicle's age is acceptable and won't be used to deny or reduce a claim. If they won't put that in writing, there are restrictions they're not telling you about. Number 7, umbrella policies don't cover everything. Umbrella insurance sounds like total protection. Yeah, you guessed it, it's not. What insurers don't explain? Umbrellas don't fill coverage gaps. They only raise the limits on coverage you already have. If your base policy excludes SAM or professional liability, the umbrella doesn't add it. It just increases the dollar limit on whatever's already covered. That's where new operators get burned. They buy an umbrella thinking it makes them fully protected, when all they've done is stack higher limits on policies with major exclusions. An umbrella only kicks in after a covered claim exceeds your base limits. It doesn't change what's covered. It's not a catch-all, it's a limit extender. Covered claim, higher limit, you're fine. Excluded claim, even a small one, you're paying out of pocket. But there's good news. If you're serious about protecting your NEMT operation from insurance gaps that could bankrupt you, we've put together the NEMT Compliance Survival Checklist that breaks down every coverage requirement, endorsement, and policy structure you need before you sign anything. It's not theory. It's the exact framework operators use to avoid $50,000 denied claims. It's free. Get it with the link in the description. Number 8, deductibles apply per incident, not per year. Higher deductibles lower your premium, but they're the amount you pay out of pocket on every single claim. That part gets glossed over. A $5,000 deductible isn't annual, it's per incident. 3 claims in a month? That's $15,000 before insurance pays a dime. New operators assume they'll just avoid claims. Then reality steps in. A minor fender bender, a passenger injury during boarding, damaged equipment. Each one triggers the deductible. If you're running hundreds of trips a month, even with good safety, incidents happen. Insurance companies push high deductibles because it lowers their risk, not yours. You might save $1,000 on premiums, but one rough quarter can cost you $15,000 or more in deductibles. Number 9. Broker-required endorsements aren't included in base quotes. Brokers and facilities usually require specific liability limits and endorsements for your operation. Additional insured, primary, and non-contributory wording, waivers of subrogation. Insurance companies don't include these by default. They quote a base policy, and unless you ask, the endorsements aren't there. You find out when you try to onboard and get told your policy doesn't qualify. Adding endorsements later can mean extra premiums or waiting until renewal. Either way, it's money you didn't plan to spend. So, here's the fix. Get the broker's insurance requirements first. Give your agent the exact list. Make sure everything's included in the original quote. Adding it later almost always costs more. Number 10. Certificate of insurance isn't proof of coverage. Brokers and facilities ask for certificates of insurance to confirm you're covered, but the COI doesn't prove that the policy meets the requirements. A COI only shows that a policy exists with certain limits. It doesn't guarantee the coverage actually matches what the broker expects. If your policy has exclusions, those exclusions win, even if the COI makes it look covered. Let me show you an example. A COI might show $1 million in general liability. The broker assumes SAM is included, but the policy excludes it. A claim happens, coverage is denied, the contract's gone, and you're liable. Insurance companies issue COIs based on what you ask for. They don't verify that the certificate reflects every detail of the policy. It's just a summary. Instead, have the broker or facility review the actual policy language, not just the COI. Request and send the declarations page and key endorsement pages that show what's actually covered. Number 11, premium audits can triple your cost. Here's the trap most operators like you don't see coming. Premium audits. Workers' comp and commercial auto policies base your initial premium on estimated payroll and mileage. At the end of the policy term, the insurer audits your actual numbers. If you underestimated to get a lower quote, or if your business grew faster than expected, the audit hits you with a massive bill, sometimes 2 to 3 times your original premium. What you do? Estimate conservatively. Track actual payroll and mileage monthly. If you're trending over your estimates, call your agent midterm to adjust. Midterm adjustments spread the cost. Year-end audit bills hit all at once. Number 12, coverage lapses follow you forever. Let your insurance lapse, even for one day, and it follows you for years. Insurers see coverage gaps as high risk. When you apply for new coverage, they'll charge 30 to 50% higher premiums. Some won't even quote you. Worse, Medicaid brokers and MCPs require continuous coverage. A lapse can void your contracts immediately, even if you reinstate coverage the next day. So, what to do? Just set reminders. Never let payment issues create gaps. Number 13, radius and territory limits restrict where you can operate. Most commercial auto policies have radius restrictions: 50 miles, 100 miles, 200 miles from your garage location. Drive outside your covered radius, you're uninsured. The claim gets denied, you're liable, and your broker finds out you violated your insurance terms. Territory limits work the same way. If your policy only covers operations in your home state, you can't legally take patients across state lines, even if it's just 20 miles to the nearest hospital in the next state. That's why you need to review your policy's radius and territory limits before accepting trips. If you operate near state lines or take long-distance transports, get those explicitly covered. Expanding coverage costs $500 to $1,500 annually, far less than one denied claim. Number 14, named driver versus any driver policies. There are 2 ways to structure your commercial auto policy: named driver or any driver. Named driver policies only cover the specific drivers listed on your policy. It's cheaper up front, but every time you hire someone new, you must notify your insurer and pay to add them. Miss this step, that driver isn't covered. Any driver policies cover anyone operating your vehicle with your permission, as long as they meet basic qualifications. But here's where operators like you get caught. You buy a named driver policy to save money. A driver calls out sick. You hire a temp or use a substitute. They get in an accident. Then, claim denied, because the driver wasn't on your policy. So what you need to do is this. If you have high driver turnover or use substitutes, pay for any driver coverage and implement a strict protocol. No one drives until they're officially added to your policy. Number 15. Claim handling timelines aren't standardized. This is something that happens all the time. You file a claim thinking your insurer will handle it quickly. Then you wait, and wait, and wait. What insurers don't tell you up front is that claim timelines vary wildly. Some insurers resolve claims in 30 days. Others take 6 to 12 months, especially if they're investigating liability. During that time, you might have to cover medical bills, legal fees, or settlement discussions out of pocket. If the claim involves a broker contract dispute, you could lose the contract before your insurer even finishes investigating. Before you buy, ask your agent about average claim resolution timelines for that carrier, and choose insurers with reputations for fast, fair claim handling, even if they cost slightly more. the cheapest premium isn't worth months of claim limbo. Before you sign a single insurance policy, grab the NEMT Compliance Survival Checklist. It walks you through every coverage requirement, endorsement structure, and policy gap that destroys startups who don't know what to ask for. This is how operators avoid the $50,000 denied claims that end businesses. This is one of those areas where mistakes are expensive. The checklist exists so you don't make them. You'll find it linked below. This is NEMT. Welcome to the Empire. Hit that like button if this saved you from a coverage disaster. Subscribe for more NEMT intelligence that protects your operation. And comment below. Did you know about these?